We're going to move on to understanding the aging method in estimating future uncollectible accounts. Let's look back at Kimsey Medical Clinic to see a more precise way to estimate uncollectible accounts, the aging method. Now, this slide lists 8 of Kimsey's individual patients' accounts, including the amount owed by each patient and the number of days past due. So for simplicity, all remaining patients' accounts are summarized in the Others row. Notice that each age group has its own estimate of the percent uncollectible, and this percentage increases with the age of the account. Management can estimate the percentage of future uncollectible accounts using historical averages, current economic conditions, industry comparisons, or other analytical techniques. A more accurate method than assuming a single percentage uncollectible for all accounts is to consider the age of various accounts receivable and use a higher percentage for old accounts than we would for new accounts. This is known as the aging method. So for instance, accounts that are 120 days past due are older than accounts that are 60 days past due. It makes sense to say the older the account, the less likely it is going to be collected. Summing the estimated amount uncollectible for each age group results in a total estimate of $5 million. Using the aging method to estimate future uncollectible accounts should be more accurate than applying a single rate of 30%, say, to the entire amount of accounts receivable, as was done previously. Now, the reason is that accounting for the age of each account should more accurately predict the probability of the account balance not being collected. The adjusting entry at the end of 2018 to allow for future bad debts would be $5 million using the aging method. Notice that when using the aging method, the journal entry to estimate future bad debts is identical to the journal entry made using a single estimated percentage. The difference is that the estimate of bad debt is likely to be more precise because it is based on the age of accounts, and older accounts are more likely uncollectible. So let's look at another one of these multiple choice. Which of the following is true about the aging method? A, no estimate for uncollectible accounts is made. B, older accounts are more likely to be collected. C, it is not acceptable for GAAP. D, older accounts are less likely to be collected. What do you think? Hope you get that right. It would be the older accounts are going to have a tougher time getting collected. They've been sitting around longer. So this aging method recognizes the longer the accounts are past due, the less likely they're going to be to get collected. This slide shows Tenet Healthcare Corporation's policies of estimating uncollectible accounts. So as you see here, we provide for an allowance against accounts receivable that could become uncollectible by establishing an allowance to reduce the carrying value of such receivables to their estimated net realizable value. We base it on aging the accounts receivable by hospital, by historical collection experience by hospital, and for each type of payer over a look-back period, along with other relevant factors. Now, a key item to be aware of is using the aging method to estimate our uncollectible accounts. Generally speaking, it's going to be more accurate than just coming up with a single percent for all accounts. The aging method recognizes longer accounts that are past due, the less likely they're going to get collected. Now we're going to look at applying a procedure to write off accounts receivable as uncollectible. So, the write-off of an account receivable has no effect on total amounts reported in the balance sheet or in the income statement. There's not going to be a decrease in total assets, or there's no decrease in net income with the write-off. We've already recorded the negative effects of the bad news when we estimated those bad debts to occur. That estimate was recorded as an adjusting entry at the end of the previous year. So let's suppose that on February 23rd, 2019, the following year, Kimsey receives notice that one of its former patients, Bruce Easley, has filed for bankruptcy protection against all creditors. Based on this information, Kimsey believes it is unlikely Bruce will pay for his account of $4,000. Kimsey previously allowed for the likelihood that some of its customers wouldn't pay, but it didn't know who. Now it looks like a specific customer is not going to pay his bill, and it can adjust the allowance and reduce the accounts receivable balance itself. Upon receiving news of this actual bad debt, Kimsey records a debit to the allowance account and a credit to this accounts receivable. The write-off of an account receivable has no effect on total amounts reported in the balance sheet or in the income statement. There's no decrease in total assets and no decrease in net income with the write-off. Remember, we've already recorded any negative effects of the bad year at the end of last year when we estimated those bad debts were going to occur. That's the key with writing off expenses in the year we received the income. Because if we wouldn't have done that, then when we received the income from Mr. Easley, these expenses of not getting paid would have happened in another year. Once again, remember, students mistakenly record bad debt expense when they write off an uncollectible account. But that's not how we do it. The bad debt expense was recorded in the prior year at the time we estimated the uncollectible account. Now let's look back and think, later in 2019, on September 8th, Bruce's bankruptcy proceedings are complete, and Kimsey had expected to not get any of the $4,000 Bruce owed. However, after they liquidated all their assets, Bruce is able to pay each of his creditors 25% of the amount due. So Kimsey receives a payment of $1,000, basically 25% of the $4,000. So Kimsey now has to make two entries. The first entry reverses a portion of the previous entry that Kimsey made on February 23rd to write off the account. So we have to restore accounts receivable of $1,000, and we credit that allowance because we don't need that now. The second entry records the collection of the account receivable. We debited cash and we credit then that accounts receivable. Note that in both entries, the debit entry increases total assets by the same amount that the credit entry decreases total assets. So collecting cash on an account previously written off has no effect on total assets, and it has no effect on net income. Let's look at another multiple choice for you. When writing off an uncollectible account, A, bad debt expense is debited, B, net income is decreased, C, total assets are unchanged, D, the allowance account is credited. Total assets are unchanged. The write-off of an accounts receivable has no effect on total amounts reported in the balance sheet or in the income statement. There's no decrease in total assets or no decrease in net income. Another key point for you, writing off a customer's account as uncollectible reduces the balance of accounts receivable, but it also reduces that contra account, allowance for uncollectible accounts. Again, the net effect is there's no change in the net receivable or in total assets. We recorded the decrease to assets as a result of the bad debt when we established it in the previous year. Companies must make an estimate of future uncollectible accounts at the end of each year. However, the actual bad debts will very likely differ from the estimate of bad debts. So, for example, in our previous example, when Kimsey used an aging schedule to estimate future bad debts in 2019, they figured it would be $5 million. As it turns out, actual bad debts in 2019 were only $4 million. This means that Kimsey's adjusting entry at the end of 2018 to record the estimate of bad debts turned out to be overestimated. Now, assume at the end of 2019 that Kimsey estimates future bad debts to be $8 million. How will Kimsey record this estimate? How will the overestimation last year affect this year's estimate? At the end of 2019, Kimsey must once again estimate uncollectible accounts and make a year-end adjustment. Kimsey estimated bad debts in 2019 to be $5 million, but only $4 million was actually written off. This means the balance of the allowance at the end of 2019, prior to any year-end adjustments, is $1 million. Now suppose that in 2019, Kimsey bills customers for services totaling $80 million, and $30 million are still receivable at the end of the year. Of those $30 million still receivable, Kimsey uses the aging method and estimates $8 million will not be collected. Notice that the balance before the year-end adjustment in this example is a $1 million credit. A credit balance before adjustments indicates that the estimate of uncollectible accounts at the beginning of the year or the end of the previous year may have been too high. It's possible that some of the estimated uncollectible accounts have not proven bad yet. A debit balance before adjustments indicates that the estimate at the beginning of the year was too low. But based on all available information at the end of 2019, Kimsey estimates that the allowance for uncollectible accounts should be $8 million. This means the allowance account needs to increase from its current balance of $1 million credit to the estimated ending balance of $8 million credit. Kimsey can accomplish this by adjusting the account for $7 million. This journal entry would include a debit to bad debt expense and a credit to allowance for doubtful accounts for $7 million. Now, in the 2019 income statement, Kimsey will report bad debt expense of $7 million along with the other operating expenses of $50 million as shown on this slide. Now, even though the $7 million in bad debts has not actually occurred, they're estimated to occur and are associated with this year's credit sales. So we show in the income statement both the revenue from credit sales and the cost of those credit sales, bad debt expense. And in the 2019 balance sheet, Kimsey will report the allowance account at the best estimate of its appropriate balance, $8 million. The balance sheet will show accounts receivable at its net realizable value, which is the $22 million, the $30 million minus the uncollectible accounts of 8. At the end of 2019, Kimsey must once again estimate uncollectible accounts and make a year-end adjustment. Kimsey estimated bad debts in 2019 to be $5 million, but only $4 million were actually written off. This means the balance of the allowance account at the end of 2019 prior to any year-end adjustment is $1 million. Suppose that in 2019, Kimsey bills customers for services totaling $80 million and $30 million are still receivable at the end of the year. Of the $30 million still receivable, Kimsey uses the aging method and estimates $8 million will not be collected. Notice that the balance before the year-end adjustment in this example is a $1 million credit. A credit balance before an adjustment indicates that the estimate of uncollectible accounts at the beginning of the year, or again the end of the last year, may have been too high. However, it's possible that some of the estimated uncollectible accounts have not been proven bad yet. A debit balance before adjustment indicates that the estimate at the beginning of the year was too low. Based on all available information at the end of 2019, Kimsey estimates that the allowance for uncollectible accounts should be $8 million. This means the allowance account needs to increase from its current balance of a $1 million credit to the estimated ending balance of $8 million credit. Kimsey can accomplish this by adjusting the allowance for uncollectible accounts for $9 million. Users of financial statements must realize that some of the amounts reported in the financial statements are estimates, and estimating the future almost always results in some inaccuracy. This slide provides an excerpt from the annual report of Tenet Healthcare Corporation. As you see here, the preparation of financial statements in conformity with accounting principles generally accepted in the US of A requires us to make estimates and assumptions that affect the amounts reported in the consolidated financial statements and accompanying notes. We regularly evaluate the accounting policies and estimates we use. In general, we base the estimates on historical experience and on assumptions that we believe to be reasonable given the particular circumstances in which we operate. Although we believe all adjustments considered necessary for fair presentation have been included, actual results may vary from those estimates. So you see, estimates are a necessary part of financial statements, but it's not a perfect science. We're doing the best we can based on those estimates. Let's go through another multiple choice. When an entry is made to write off an uncollectible account, A, bad debt expense is debited, B, net income is decreased, C, total accounts receivable is unchanged, or D, the allowance account is credited. I'll give you some time to look this one over. You got it. I hope this was reiterated many times, that the whole reason we take care of that uncollectible allowance is so it adjusts the expense in the period the revenue was earned. Therefore, when an actual entry happens, it's not going to change the balance sheet or the income statement at all. Let's look at the allowance method and the direct write-off method when we look at accounting for uncollectible accounts. Under the direct write-off method, we write off bad debts only at the time they actually become uncollectible, unlike the allowance method, which requires estimation of uncollectible accounts before they even occur. Now, the direct write-off method is not, please hear me, is not allowed for financial reporting under generally accepted accounting principles. It is only used in financial reporting if uncollectible accounts are not anticipated or are expected to be very small. The direct write-off method is only used for tax reporting only. This slide highlights the timing difference between the allowance method and the direct write-off method for an example. For simplicity purposes, assume that our estimate of uncollectible accounts is going to be 2,000 at the end of 2018. Turns out to be correct. And actual bad debts in 2019 are 2,000. Under the allowance method, future bad debts are estimated and recorded as an expense and as a reduction in assets in 2018. Under the direct write-off method, though, we make no attempt to estimate future bad debts. We record bad debt expense in the period the account proves uncollectible. In this case, we report the bad debt expense and reduction in assets in 2019. The direct write-off method violates GAAP since sales are recorded in one period, 2018, and the related bad debt expense is recorded in the following period, 2019. Notice that either way, the ultimate effect is a $2,000 debit to a bad debt expense and a $2,000 credit to accounts receivable. The difference between these two methods is all in the timing. It's really important to understand that. But again, for our purposes of accounting, timing is everything. We want to report the expenses associated with those revenues. Again, common mistakes. You're seeing this for each lecture. Some students erroneously think firms should reduce total assets and record bad debt expense at the time the bad debt actually occurs. Companies anticipate future bad debts and establish an allowance for those estimates. Note, the direct write-off method reduces accounts receivable and records the bad debt expense at the time the accounts receivable proves uncollectible. If the credit sale occurs in a prior reporting period, bad debt expense is not properly matched with revenues. Also, accounts receivable would be overstated in that prior period. So please understand that direct write-off method is not acceptable, generally speaking, for financial reporting purposes. Let's check out another question for you. On December 31st, before adjusting entries, a company's balance of allowance for uncollectible accounts is a credit of $2,000. What does a credit balance prior to adjusting entries indicate? A, the company did not estimate bad debts last year. B, last year's estimate of bad debts was low. C, the company's estimate equals actual bad debts. D, last year's estimate of bad debts was too high. The allowance for uncollectibles is the contra account. The balance gets reduced for actual bad debts. If the account balance at the end of the year is a credit, then estimated bad debts for this year are greater than this year's actual bad debts. Here's another one. On December 31st, before adjusting entries, a company reports the following balances: accounts receivable, $100,000, an allowance for uncollectible accounts, a $2,000 credit. The company estimates bad debts to be 20% of accounts receivable. The adjusting entry would include A, a debit to bad debt expense of $18,000. B, a credit to allowance for uncollectible accounts of $24,000. C, a credit to allowance for uncollectible accounts for $22,000. Or D, a debit to bad debt expense for $20,000. A, bad debts are estimated to be at $20,000, which would be 20% of the accounts receivable. The current $2,000 credit balance needs a credit adjustment of $18,000 to be equal to the $20,000 credit. The adjustment of $18,000 is recorded as a debit to bad debt expense and a credit to the allowance account. We're going to finish this chapter by going through a comprehensive problem. Exercise 513. At the beginning of 2018, Brad's Heating and Air has a balance of $26,000 in the accounts receivable. Because Brad's Heating and Air is a privately owned company, the companies only use the direct write-off method to account for uncollectible accounts. However, at the end of 2018, Brad's Heating and Air wishes to obtain a loan at the local bank, which requires the preparation of proper financial statements. This means that BH&A now will need to use the allowance method. The following transactions occur during 2018 and 2019. A, during 2018, install air conditioning systems on account, $190,000. During 2018, collect $185,000 from customers on account. C, at the end of 2018, estimate that uncollectible accounts total 15% of ending accounts receivable. And then D, in 2019, customers' accounts totaling $8,000 are written off as uncollectible. Now, the first requirement is for us to record these transactions using the allowance method. So we've got our 4 transactions we're going to use the allowance method on. So the first one, install air conditioning systems on account, and then what was collected, the 15% estimate of uncollectibles, and what was written off. So for the allowance method, the first will be an accounts receivable of $190,000, a credit to service revenue for $190,000. Provide services on account. Then we show collecting the cash. Debit to cash of $185,000, credit the accounts receivable. Next, record the allowance for bad debt. We estimate 15% of what's left is going to be uncollectible. The $31,000 is the accounts receivable at 15%, which means we estimate the bad debt expense at $4,650. So our credit to allowance for uncollectible accounts will be $4,650. Then we know we wrote off $8,000 of accounts. So we will debit our allowance for uncollectible accounts of $8,000, and we will credit those specific accounts receivable for $8,000. Now we're going to go back and record these transactions using the direct write-off method. As you see here, the first two are identical. Accounts receivable, service revenue of $190,000, and then B is collecting the cash of $185,000. C, there will be no allowance and no writing off an estimate of bad debt. But D is when we will then take the bad debt expense and credit the accounts receivable. As you see here, the difference is we don't have that contra account, the allowance for uncollectible accounts. Next, we're going to calculate the difference in net income for 2018 and 2019 between these two methods. So, as you see, in 2018, by using the allowance method, we wrote off $4,650. By using the direct write-off method in 2018, we would have written off nothing. In 2019, using the allowance method, there's nothing, but under the direct write-off method, in 2019, we would have written off $8,000. Under the allowance method, we record a bad debt expense in the period we estimate the bad debts. The difference in expenses between the years relates to the fact that bad debt estimates in 2018 did not prove to be the actual amount occurring in 2019.